analysis. So this is how I'm going to look at this particular week, the week we are today. That is on 26th August. So we start from the DXY. Let's go back and start from the DXY. DXY, 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 DXY. Let me get a clean chart. So from the DXY, it's clear that the week has been really bearish. The week has been bearish. We have had a very continuous week. This is a bearish week, a small pullback, then bearish week. We can still see there is a violation of the 50% of the week. You see, this is a short-term low. This is a short-term low down here, and the short-term low has been, its 50% has been violated. That is the week of that short-term low. I usually look at the short-term low. I mean, a week of the short-term low is preferably best to use when you want to see if the market would actually attack the other side of the week. Like you take as an example, you see this candle here has that week. So once the pressure is traded, when the price is traded over 50% of that week, then we are likely going to trade lower. We're going to likely trade lower, and that's exactly what is happening. We have already traded lower to the 50% of it. So what I'm expecting is just a small retracement upwards, and then the market will collapse down, attacking this sell side liquidity, another sell side liquidity. You see, there's a fair value gap here. There's a fair value gap here, a small one, but quite an important one, because this was a high that was broken by this candle that created a fair value gap. So the first point is to see how the market treats these two things. There is a gap also. You see these two candles, these two weak candles. You have this one closing, and then the other one is not opening exactly at the same place where the black one closed. Let me look keenly. Yes, if you zoom, you realize there's a difference. You see, there's a gap between the upper part where price closed and where the other one opened. That's a gap, definitely. So those things are usually market magnets. So we expect the market to rise a little bit, then drop. So this week we are looking for a high of the week from Monday to Wednesday. Then the DXY will be dropping. So you do that on the opposite of EU and GU. Let me go directly to gold. Or yeah, let me just go directly to gold. The gold chart. From the gold chart, let me make sure I'm choosing the one with. Okay, let's go here. We all know that the weekly chart has been moving. The weekly market, the gold market has actually been bullish. It's been bullish. This market has purely been bullish, and we will continue to be bullish until the market gives us a reason to do it, a reason to sell. So the first thing that happened was, this was the week. This week here, this weekly candle here had a very big week that we waited the market to violate, okay, which it did. This one came, failed, and the market traded lower, but then this other one broke higher, broke this week, broke this high, and then the next week also left a fair value gap. There's a weekly fair value gap here, but then the market is continuing up. Currently we have also another weekly high. You can look at this one here. There's a weekly high here, a short-term high on the weekly is falling up there as a short-term high, but that candle has a week, a long week. So we want to see the market trade at least to the 50% of it, then eventually to go higher. And on the lower side, we would not want to see price trade beyond 50% of the lower side of this candle. We look at that. This candle has a very long wick, also lower. So the low it should be 50% of it. So on the lower side, the market wanted to retrace downwards. Remember, gold, we're having a whole-time high, so there is no place to really measure exactly. So if you do that, I want to see the 50% of that. Many other ones here. We delete these ones that are confusing. We delete this one, and then let's measure this wick. This candle has a long wick. So if anything should happen, the market should only retrace to the 50% of this one and continue upwards. That is if there will be any pressure for the market to trade lower. But then if you look at the daily, let's look at the daily. From the daily, the market rejected this fair value gap. It did not close lower. And what did it do? It went upwards. So let's try to look at so the expectation was to see price climb higher to close above this one. But of course, you take the market after a dip. So we go to the lower time frame and try to find where the market could dip to before it rises. Okay, that's exactly what I'm trying to do, is to find the market, the point where the market could be going, okay, before it rises. If you look at this one here, the first thing we usually cover is the Asian, that is from 3 in the morning, that is London, 3 in the morning to 7. That would be a range. Have a range there and see if the liquidity of that range will be swept. So ideally, there are places the market would come. There's this order block here. There's a fair value gap here. Although it was traded into, still the market can always come and trade into that fair value gap again. There's also a short-term low here, this low here, which can also work as an inducement. The market can still come and do a 50% of this region, Just trying to find places where the market could return, or else we wait the market to sweep the liquidity of the Asian, give us a market structure shift from the lower side, from the lower time frame, like 5 minutes, and see it rising, and then we target the high of that of previous day, or just the high of that Asian range. So that is it. We are bullish on gold. We're bullish on gold. We're just finding regions where it can just dip to, then it goes. If there will be nothing today, then we let Monday create more data as we go on to attack the market this week. That is it. This is so easy, so simple. Do not complicate the market. Of course, I have my other indicator, the Piphawk indicator, which is here. We have this one here, and then there's, of course, the other indicators that have not been shown on this recording, but I can still be used to capture the market trends when it changes and when to enter. That is it for this week, and you guys make sure have the best psychology to attack the market. Bye-bye. That is Piphawk for you.